Hi everybody, welcome back to Tubes on Tuesday. This week we were fortunate enough to have Bradley Beer from BMT Quantity Surveyors in our boardroom for a chat about depreciation schedules.
So a property depreciation schedule is a document really. It's a report that we write and put together. It has a lot of numbers in it. It tells you what deductions you're able to claim for depreciation. Any investment property is getting older and wearing out, and so are the items within there, and the tax office says you're allowed to make a deduction for the wear and tear of the building and the items within it. We work alongside the accountant. The accountant does a lot of your tax returns. We're a specialist just in this depreciation area. No, I wouldn't agree with that. The purchase of brand new property means the depreciation is actually more, yes, but it doesn't mean it doesn't exist in older properties. Older properties still have substantial depreciation benefits. Property that's built 60 years ago, hopefully the original carpet is not still there. Hopefully the original stove or hot water, well, the hot water service is definitely probably still not there. The stove is probably not there from the original 60-year-old house. Different people have done work to these properties since they were bought. When you buy a property now that is older, we look at things like this. What has been done to this property over this time? It might have had a new driveway 5 years ago. Yeah, look, you get to claim a certain amount of a deduction against the structure of the building. So, you know, the concrete floors, the walls, the roof, the driveway, the fences, all of those things. There is a date range on these things though. So you get to claim 2.5% of the actual cost of the structure each year, providing it's been built after the appropriate time, or these things have been done after the appropriate time. A new room that was added onto the back of a property 10 years ago on that 60-year-old property is something that we get to get this structural claim. The other part is things like carpets, hot water services, stoves, blinds, curtains. They call this plant and equipment. Things that don't last as long, we get to claim these things quicker, and there's no special age restrictions. Look, it's hard to answer an exact number on that, but I believe that around 80% of investors are not maximising this deduction. So a lot of people are claiming deductions, but they've guessed, or their accountant's guessed, or something along those lines has happened. And it can be more if it's actually done properly. We actually physically go and inspect the property. We go and have a look. When we get to that site, one of the guys comes out, or girls, measures up things. Have a look at the condition of things in the property. We've got our little digital measuring devices these days. They carry tape measures, and sometimes those little things, they can walk along the driveway and measure how long the driveway is. Look at the driveway. Was it put there 3 years ago, or is it 60 years old like the rest of the house? Look at the actual property, inspect it, identify everything that we can claim, measure it all up so we can bring it back. We then estimate the cost of all these things, put values on all these things, prepare the report. We might need to talk to councils or authorities on, you know, to find out when buildings were actually built. Someone has some data on that sometimes. From there, we prepare that report with all the estimates in it, the values on the items, the amount of thousands of dollars depreciation, hopefully, that we can find for the client. Look, there's a few reasons, Simon. If you're going to do it cheaply, you're probably going to cut some corners. We go out to site. It's always one of our staff that comes to site. We don't have contractors that don't know what they're doing with that stuff. We want to be thorough and get every bit of deduction we can for you. In order to do that, we're going to charge a little bit more than that $200 to actually do this report. The benefit to you would be that you probably get more deductions because we'll find things there that other people won't find if they don't go and have a look at the property.
I thought it was interesting hearing Brad say that approximately 80% of people who already own an investment property don't actually have a depreciation schedule. They're very important. Another common mistake that I see with property investors is too much emphasis is placed on selecting a property for its depreciation benefits. Certainly a newer property will attract more depreciation benefits than an established property. However, the primary objective of investing in the first place is for our money to grow. The correct order to do things is to select a property for its capital growth potential in the first instance. Then the depreciation schedule becomes important to maximise our taxation benefits on that particular property. Until next week, see you then.